You We'll do 6 hours of education. So we discussed that we're going to meet every Friday at this time. So for the 27th, the 6th, and the 13th is 3 2-hour sessions. And then from there, we're going to move into practice trading. We're going to do 6 hours of practice trading. So that'll be taking what we learned in the education piece and actually applying it, walking through, making sure that you understand how to review the charts, how to enter into the trades, how to manage the trades once you're in, how to exit the trades. And that's practice. We'll do 3 2-hour sessions for that. And then from there, we'll move into real trading with real money. So it'll be 3 2-hour sessions. So the total program mentorship is 18 hours. Then once you're done with the mentorship, that piece of it, then you'll go off, you'll do it on your own. Because you have two paid mentorships, you can come back to me. Well, each mentorship comes with 10 one-on-one coaching sessions. So that means once you're done and you're doing it on your own, you can come back to me 10 times, well, 20 for your group. Um, and hey, can you walk me through what I did here? Can you explain this to me? That type of thing. So that's how this is going to go. Okay.
Right. Right.
And then
Right.
everything is recorded after after each session. I'll post the recordings to Google Drive. So, and I'll send out a follow up email with the link for the recordings.
Gotcha.
All right, so we'll go ahead and get started. All right, so this class is it's called Mastering Options Trading, and we'll get into what is the difference between investing in shares of stock and trading options. But the course focuses on options, but the strategies that I'm going to teach you will work both for investing as well as trading. So, a little bit about me. My name is Sharae Smith. I'm the founder of 2S Investment Group. Background wise, I have a bachelor's in accounting, I have an MBA, I have a certification in project management, I have some other things going on. I'm certified data analysis. And so that's kind of where my strategies came from. I've been retired now for 2 years from a 25-year career in corporate America. When I worked in corporate, I retired from risk management. So I'm going to teach risk management was my life. So I'm going to teach you risk management in a way that it's not being taught by anybody else in the market, any of these other stock coaches or trading coaches. In terms of investing, I started investing in 2009. Had no background in investing at all. What piqued my interest was really the Super Bowl, the E-Trade baby commercials. That's about when those E-Trade commercials came out. So back then, I started an E-Trade account. I started just buying shares of stock. I'm buying McDonald's, Pepsi, General Motors. My grandma was retired from GM, so I'm just buying, shares of stock. And then 2010, I went back to school for my doctorate, and I kind of probably sold those shares in order to pay for tuition. And then 2020, obviously, we had a lot of free time on our hands. Now we have these apps, Robinhood, Thinkorswim, different things that came out. So I got back into investing in 2020. And I was sharing what I was doing on social media. And so it started getting the attention of people. They were following me. Um, and so someone approached me and said, "Hey, if this is what you're doing trading stocks, then you should get into options." And so I took an options class. Back then, during the pandemic time, well, even now, all you need is a social media following and you can, get clients. And so I took this class from this guy. I realized he didn't know what he was doing. He just had a social media following, and he's actually in jail now. So I taught retaught myself. So for a period from 2002 to 2003, I took a step back. I taught myself. I developed a new method, which is what I'm going to teach to you all, which is completely different than anything you'll find in the market from any other trading coach. So far, that says 100 clients. I've done maybe probably over 150 clients that I've coached. I've had people as far away as Mexico, Asia, the UK, Mexico, all find me on social media. My social media went from 700 people to over 7,000 people in 3 days. It grew so fast that I had to shut it down because I could not service everybody as a team of one. And it's still just me, one. I tried to expand, but it didn't work out. So that's a little bit of background about me. So do you guys have any questions before we start?
Nope.
No, we're
Nope.
fine.
All All right, so course overview. So basically, what we're going to go over, understanding the importance, functioning importance of the stock market. We're going to differentiate between trading and investing because there's different strategies that are associated with these. Trading is more short term, investing is more long term. We're going to analyze the roles and impacts of institutional and retail traders. So, institutional traders, that's your big money. Those are your pension funds, those that work with large net worth individuals. Retail traders, that's everyday people like you and I. Those that just, using our phone or whatever resources we have available and participating in the market. We're going to develop skills to research, analyze, and purchase shares of stock. So, what I'm going to teach to you, even though I'm focusing on trading and on options, it also will apply to, how you go about, a question I always get asked is, how do I know which shares, what stock to invest in? All of that really is going to be specific to you. It's based on what your goals are, what type of investor you want to be, and you will work through that process because it'll be different based on what your end goal is. And then also, lastly, we're going to gain an understanding of options, trading strategies, and risks. So when you're on social media or YouTube and you're seeing these large dollar amounts being flashed all over, the reality is they're trading options. They're not doing shares of stock. And we'll look at, the difference between what you could do if you're doing stock versus what you could do with options. So the money really is in options. And I was telling Mo, like yesterday, I had someone book with me first thing this morning, 9 o'clock. So I was in a trade. I had to exit it, and it was something I paid like $40 for, and I sold it at like a $2 loss because when the market opened, I wasn't going to be able to manage it, and the thing ran up to over $300 this morning. So options is really where you're going to see the significant shifts. So even though the stock only moved like 3 or 4%, the option moved 500% in that case. So that's what I'm going to be focusing on. Okay. All right, so I got to do my risk disclosure, cover myself. Options requires the disciplined, informed approach, which I'm going to teach you to be disciplined, and I am going to inform you. There are risks associated with options trading, and so you're encouraged to make well-informed decisions. Again, I hate when I hear my clients say, I'm not going to use the word hate, dislike. When I hear my clients say, I think it's going to do this or whatever, no, I'm going to teach you a strategic way to go about doing this so you're not just, guessing, I guess, or it should not feel like gambling. If it feels like gambling, come back to me. We're doing something. We need to work on something. Okay. All right. So we're going to get into it. So why the stock market matters. All right. So if I'm a business and I need to raise money, the only way that I can raise money as a business, well, there are multiple ways I can raise money as a business. I either can borrow, which means I have to pay interest. I'm going to have to pay the money back. I can sell more products or services, which means I need to now have clients. Even though I can offer all the products and services I want, I still have to have people that are willing to buy those. So another way that businesses can raise money is by issuing shares of stock on the stock market. So that means they open it up, allow the public to be able to purchase shares of stock. That's a way for them to get a cash influx of cash, and then they're able to grow their business. So that money is then used for expansion, research, job creation, capital asset purchases. And overall, it leads to a greater economy, right? A stronger economy, because now if, businesses are growing, they're able to get money without having to repay it in terms of debt payments. They're able to hire, that feeds into the economy. You now have, property, employment taxes, income taxes, different things like that. So that is one way in which the stock market matters as it relates to business growth. The stock market also matters because it allows individuals to build wealth, right? Where the whole reason that you participate in the stock market is because you want to be able to invest in a company that company is the value of that company is going to appreciate over time. So a dollar invested today hopefully grows to 5, 10, or more dollars in the future. So the stock market exists to allow individuals in order to grow their wealth. Money sitting in the bank, you're getting very little to no interest or return. The bank's using that money anyways to go ahead and invest it and lend it out and get interest on it. So this gives you an opportunity to do the same with your dollars. So stock ownership gives individuals a chance to own part of a company. As I mentioned before, long-term investing beats inflation and obviously bank savings. And then also it's a tool for retirement and generational wealth. Obviously your investment portfolio becomes an asset that you can then pass along to others. The pulse of the economy. So the stock market will let you know what people think about the economy, how the economy is going. Basically, when the economy is going well, that means people are spending money, they are investing. Overall, the gross domestic product is increasing. Unemployment, when people are working, obviously they have more disposable income. So that lets you know how the economy is actually doing. The stock market is a measurement of how the economy is doing. When things are going well, people are making money, they're spending money, businesses are making money, stock prices are going up. We're just coming out of a period where the stock market was at all-time highs, is starting to retreat back, but that just gives you, people were buying, we had housing, explosive housing growth, car prices are at their highest. So that's how that the economy is overall considered to be doing well. And then policymakers use that information in order to make decisions in terms of the economy. So whether or not we need to slow down growth or different things like that, they use the economy and the stock market together to make those policy decisions. Stocks. So stocks, they're highly liquid. So think about any other type of investment. If you're investing in real estate, that is not as liquid. If you wanted to liquidate, a property, now you got to buy, seller, pay all kinds of fees. With the stock market, is very liquid. You buy something today, if you want to turn around and sell it in a couple hours, sell it in a week, sell it in a year, 5 years, that money is available for you whenever you need it. So that is another reason why people choose to invest in the stock market. Also, you can adjust very quickly. So if the market is doing well, like we just talked about, the market was doing well, you can adjust. If the news is saying, that the economy is slowing down or turning around, or you're seeing layoffs, which is some of the things that we're starting to see right now. So that suggests that the economy is starting to slow down. You can adjust for that very, very quickly by investing in the stock market. You don't just have to, like with a CD or long-term investment, you get penalized for, selling or different things like that. You do have to pay taxes on capital improvements on money that you make on the market, but it's not like right at that time. And then investors can adapt fast to market changes, which is what I mentioned before. So you just kind of keep an eye on the market, see what's happening, buy, sell, and adjust. And then lastly, stock market helps to keep companies in check. So companies that are publicly traded, they must go through a rigorous process. One, they have to get approved to actually offer shares on the stock exchange. So that means they go through extensive audits, reviews of their financials. Again, I come from an audit background. I was internal audit for 12 years. So there's a rigorous process. Obviously, they want to protect, meaning the government wants to protect investors against companies. You don't want people investing in companies that have like a shady dealings or unstable financials, which you'll see that all the time, where there's lawsuits related to that. It gives insights into performance and risk. Publicly traded companies must report any kind of lawsuits that they have going on, any acquisitions, major investments into other companies. So you are able to keep track of how companies are performing, those publicly traded companies are performing. When you're a private company, you can kind of do whatever you want to do behind the scenes. It doesn't matter as long as it's not illegal, but you're not required to report on it. And then obviously it builds trust and improves business ethics. When you know that you have another two sets of eyes, you have the SEC, Securities Exchange Commission, and then you also have your public investors. You have now additional sets of eyes watching everything that you do. So that causes you to want to engage or have operations that are ethical. Okay. Questions? No. Too far. All right. So moving on into the next section, how to research stocks. So I'm going to go through my process for how I actually do my stock research. So first thing, one way you can research stocks is through news and media outlets. So I list here some of the news media outlets that I use. So my primary source is the New York Post and the Wall Street Journal. The reason for that, New York Post, the stock exchange is located where? In New York City. So I want to know what is the news that they're reading when they're riding, the subway into work in the morning. Well, I want to have access to the same information that they're reading. So that's why I read the New York newspaper. Wall Street Journal, obviously that's business focused. So I want to know what are some of the major news developments. And then the other one is actually the Washington Post. I want to know what's going on Capitol Hill. So what are legislations that they're voting on? What meetings are they having? And that type of thing. So with that said, what I'm going to do at this point, I'm going to come off of here and I'm going to go to the New York Post. So when I'm reading the news, I'm not reading the news. Let's skip off of here. And I'm going to go to the New York Post. Okay, so when I'm reading the news, I am not reading each article. What I'm doing is I'm scanning the news for three things. I am looking for any headline that impacts an entire industry. I am looking for any headline that names a specific company, or I am looking for any headline that is a major development, like a war or a new legislation that was enacted or something like that. So that's what I'm scanning for. I don't spend a lot of time on the news. I just want to know overall what's going on. So I'm just going to go down quickly, see what's here. So you got Burger King. So if I'm looking for, when you say, okay, well, how do I know what to invest in? Well, the news is a good starting place. Burger King. Now I see, Burger King. Keep going down. I see McDonald's. So it looks like some things in that space. Food service, I guess, is what I would start looking at. Food service stocks. I see JP Morgan banking, but I actually made some money this morning off of banking. So now you got Netflix. Remember I said we're looking for company names. So we got Netflix and we got Warner Brothers. That's really what I'm looking for. There's war. Remember I said I'm looking for major developments. Anything that could have an impact on the stock market. War.
I have a question.
Go ahead.
Well, what about a lot of times I see a lot of people, they say the SP 500. How do you because that's a bunch of companies combined, right?
Correct. So the S&P 500 are 500 companies that are listed Standard & Poor's, and those are large cap companies. And actually, that's what I trade on a daily basis. So I'm going to teach you all how to actually do that. Correct. So if we come here, let me just put in SPY. You're able to see that? All right.
Do you have a platform that you suggest that we use that'll be easier to us since we're beginners,
Yeah.
or?
So I teach on Robinhood. So that's section two.
Okay. Oh, sorry. All right.
Yeah, so you moving us along. Y'all got the mentorship, so y'all got the full beginning to end. But yes. So yeah, to answer that question, yeah, I teach on Robinhood because it is the easiest for beginners to learn, and then I say, hey, once you learn this, then you can go off. Also, Robinhood is the cheapest in terms of their fees. For contracts, it's only 4 cents. On Thinkorswim, I think I pay like 65 cents per contract. 50 cents on Webull, I believe is the price. So I have like five different, I have multiple accounts on three different platforms, four. Um, but yeah, so that's what we work on. And so yeah, so the S&P 500, that is what basically how the market is doing. So it's down today overall, and it tracks 500 major companies. Did that answer your question?
Yes, it does. It definitely does. And
Okay.
with Robinhood, we have to set up a specific account because I have Robinhood, but
Nope, no.
I,
If you already
okay.
have it, yeah, most people already have it.
Mhm.
And if you don't, then we'll go through. That'll be your homework for number two. I usually send out the instructions because it's a certain kind of way I want you to set it up.
Perfect. Okay.
All right. Let's see here. Okay, so New York Post. So that's what I'm doing. I'm not going to spend much time on that, but basically what I'm doing is I'm scanning through. I'm looking for anything that, like I said, impacts an entire industry, like war. For example, war, that means guns, right? Ammunition, that type of thing. So I'm just going to hop over here. I'm going to show you what's happened with this stock. This is what's been happening since all of that unrest in the Middle East. The stock price has gone up. That was uncertainty back here, then it went down, and now it's going up. So that's why you want to scan. You want to kind of get an idea of what's going on, because that's going to give you ideas of where to go to invest. That's how you'll know. You'll come in, but I'm gonna teach you all this when we get to the Robinhood piece of it. But this is just how your process behind how do you go about finding stocks to invest in, how to do your stock market research. Okay. So these are just some different sources you can use. Company website. So on the company website, when you go to a company website, the website is designed to try to sell you a product or service. So that's what you're going to see. However, usually buried on the bottom in very small print, you're going to see a piece that says investor relations. Sometimes you have to dig around. I can't remember. There was a company I was just working with, MSTR, and it was like their stuff was buried, and MSTR, they just buy Bitcoin. That's all they do as a company. And so if you don't want to buy Bitcoin itself, you can just invest in buy shares of stock in the company MSTR. So their financials was like really, really hidden, really hidden. But so company website. So I'm going to ask you all, give me a company, any company that you want to look at.
Let's look at Google.
You want to look at Google? Okay. That's a new one. Nobody ever picks Google. Oh, it's taking me to Google. If I do Google, nobody ever picks Google. All right. About
Louis
Google.
Vuitton.
LVBS. All right. Let's see. So we're on Google. So company info. So usually, again, they're trying to sell products and services. That's what you're going to see when you go to Google's website. Usually when you go to the bottom, it's going to be buried at the bottom, some small print. So here we go here, investor relations. That's where you want to go. So if you are looking at investing, here's where I was saying they're required to report their earnings. So what you're going to want to do is you're going to want to look at their earnings. So this is 2025 quarter 1, 2, 3, 4, and then they got their year end and fiscal year. So what we're going to do, we'll look at their earnings release. I'm just going to go through the page real quick. You also want to look for news. You want to see, are there any major developments? So here they're announcing an agreement to acquire Intersect to advance U.S. energy. So it looks like they're going over into the energy industry, it looks like. I would open that up and try to see what that's about. Let me see here. Recent updates. I'm looking for any changes in their C-suite. So any changes to the, CEO, chief technology officer, chief legal officer. I want to know if, there's any changes, any new products that they're developing. You want to know, what's going on there. And they are required to report that information. Okay, so you can subscribe to some alerts if you want to get their alerts. All right, so what I'm going to do, I'm going to go back up here. Now we're going to look at their earnings, and I'm going to show you what you should be looking for in their earnings. So here, there's usually an executive summary at the beginning. I was a corporate accountant for 10 years. I mentioned I had a 25-year career. Fresh out of college, I was a corporate accountant for 10 years before I moved into audit and risk management. So I used to put these things together. So there's generally an executive summary, right? Because they're busy, they don't have time to read through all the the entire document. So
Correct.
here it's showing here that their revenues increase year over year. So this is the type of stuff you want to look for. If you're considering investing in a company, now your strategy could be to find struggling companies. So I'm not saying you just want to understand what's going on with that company when you're making
Correct.
that decision. So I'm not saying you only want to invest in companies with year over year increases. You might be looking for companies that are struggling and you want to go ahead and get in because you know they're going to be fighting to turn that company around. But
Correct.
you decide what, your profile looks like, what your goals are. Says here YouTube increased ads, which that's to be expected. So one of the things that I've been noticing is ad revenue. So companies that do ads like social media, digital marketing ads. So remember we're talking about how do you know what companies to invest in? Those are the types of companies you want to look at. A lot of these major companies understand that, hey, ad revenue is where it's at. Ads is where I'm going to get more clients and more customers. So while you may not be looking at the companies themselves, look at the ones that support these big businesses as well. So that's what I'm seeing here. They're having ads, increasing ads and subscriptions. You got cloud platforms, so AI infrastructure, different things like that. Again, we already saw that the revenue, what they're going to do is comps, comparables, 1 year over the next. How did we do in 2024 compared to how we did in 2025? So as you can see here, for the quarter, they increased quarter end for 2024 versus quarter end for 2025. Same thing with the year. They increased, let me blow this up a little bit. It's not blowing up for you. It's blowing up for me, but not for you. I'm on a different device. I'm on my MacBook. My Dell will blow it up. But I'll just highlight it here. 2024, 350 to 402. So you see financially they're doing well. Then the other place I would want to look is any material misstatements of the financials, which I don't think they have any because it would have been in that executive summary. Also any lawsuits or anything like that. So that stuff is typically more towards the end. This is just more detail about their different segments and how they're doing. And that is it. That's all they have here. Okay, so that's what I would be looking for here on investor relations. Another place that you can do stock market research is social media. This is my least favorite, but people do it. So there are communities on social media that you can sign up for where, they'll discuss, stocks. They call them meme stocks. So one that was going around last week was IBRX. I think it was, IBRX. It turned into a meme stock last week, and someone brought it to me Saturday. So there are communities, trading communities on Facebook, Reddit, YouTube, and the only thing I say about that is just be cautious of scammers. So if you're on a group or somebody's trying to get you to sign up, one, don't send anybody any money. I'm teaching you how to do it yourself. Do not send anybody any money who's going to put it in some platform and give you access to an interface that's going to allow you to see. I had two people, one person with Bitcoin who sent the money through for some Bitcoin thing, and one person who thought they were buying Apple stock. And they sent $100, and this person sent them back a screenshot showing their $100 was not worth $49,000, and they were trying to figure out how did they cash out and get their $49,000. And then those companies will say, well, hey, you gotta send me more money because I gotta pay fees, and they're just playing on the ignorance of the people that just are not aware. So definitely be careful. If you go on that website and all they're showing is people standing in front of big houses, big cars, and all of that, that's not going to be legit. Okay. So make sure you're vetting those communities. But people use them. All right. And then one of my favorites. All right. One of my favorites, this is my favorite, and this is the brokerage tools, or aggregator tools is what I call them. So basically what they go out, think your Yahoo Finance. When you go on Yahoo Finance, you're going to have the charts at the top. It's showing you the stock market. It's going to have all kinds of news. It'll show specific companies and tickers. So these are some of the what I call aggregator resources. So they also do this, like within Robinhood, they have these same things, or within the different investor brokerage accounts as well. But I'm sorry, I'm on this MacBook and this thing is super sensitive. Go. All right, I'll just use that instead of my mouse. My favorite is barchart.com. So I'm going to show you barchart.com. I had kind of pulled it up a little bit when we were doing the research piece. So this is barchart.com. So basically what it does is it goes out and it does like scans the news, and it tells you. So here we got, AI disruption. So AI stocks for years have been taken off, started taking off 22, 21, 22 on through 25. Those stocks have now started to slow down. So now you're starting to see a retreat in the market. You got geopolitical risk. So it goes out. Instead of going to each of those individual news sources, what you can do is just use something like a barchart.com, and it'll go out and do an aggregation of the news, and it'll tell you, what's going on right here. So here's, I see something with Stripe, PayPal, Amazon stock. Let's see here. U.S. stocks sink as oil prices rise. Worries about AI. A possible war, which we already are aware of that, risk. So basically that's what it does. It goes out, it scans major news, kind of gives you a one-stop shop for what's going on and what's driving an impact in the market. One of the things that we talked about is the S&P 500. So that's basically 500 companies that are tracked by the index. It's basically called an index. And basically that'll give you an idea of what the market is doing. So that's when you're watching the news and it's scrolling across and it's talking about the Dow Jones, it's talking about the NASDAQ, it's talking about the S&P 500. Those are different buckets of companies that are tracked by this index. So Dow Jones are industrial companies that are like steel mills, those ones that are heavy in production type things. That's what it's tracking. So it gives you an idea. Remember, we talked about it gives you the stock market gives you a pulse for how the economy is doing. So that's what this is. It tracks gold, silver, commodities, corn, wheat, different things. Those things are typically purchased in large quantities. Fresh out of college, my first job was at an energy company. And so we purchased, in order to create energy, you had to buy coal, and you burnt the coal. So we bought coal by the train loads and by the tons and stuff like that. It's not buying, we're not buying. So that type of stuff is tracked. What is the price for those? And then the way it's broken out, you have, different area. You have the news, you got investing, you have stocks. I'll go into more detail as to how to use these, but this is just another resource that you can use for doing your stock market research. And then from here, you can search for specific companies. And then these are some others here. They all pretty much perform the same function, but my favorite is barchart.com. All right, so now we're going to move into bull and bear markets. So before I move into that, I'm going to ask, does anybody know what is the difference between a bull market and a bear market? I heard the terminology.
Well, the bull market is when the market is doing when it's doing good. And the bear market is when it's doing bad.
Yeah, kind of.
pretty much.
Kind of. All right. So what is the difference? All right.
Bull is up,
Yeah,
bears down.
the horns are
Yes.
up. Horns are up. Horns are
Yeah.
up. And the bears down, right?
Yes, that's it. That's it. Because a down market isn't necessarily a bad market if you're on the right side of it. So with options, that's why we
Well,
want to learn options.
all right, exactly. Okay.
Yeah, because a bear market could be a good thing. The things that I made money on this morning was bear. The fact that
And
the
that's when you
market was going
sell,
down.
correct? You sell in the bear market.
What will be called shorting the market.
Okay.
Shorting the market. And not necessarily that you will want to sell. When prices are down, that's when you want to buy, right? You don't buy the highs, you buy the lows.
Right.
So if you're in positions, and then that's when you have to start making decisions. I mean, depends on what your goals are. So if your goal is long term, you don't do anything because we know it dipped down and it's going to come back up. So that those are all the things you have to consider when you start investing or trading. Doesn't necessarily mean you sell just because the price went down, because it could be down today and then rebound back up tomorrow, and now you're out of your position.
Yeah.
Yeah, and you sold for less than what you could have sold had you
That's
just
the
held.
beauty of the option.
Yes.
You can make money on the bull market and the bear market.
Exactly, and that's why everybody pretty much, that's when you're seeing all of this stuff on social media, it really is the options trading is what they're
Yeah.
doing. And then
Cool.
even, and again, I can teach you all strategies. It all just depends on what you're trying to do. So what I do is, like, say for instance you bought your stock and your stock is now increased in value. Now you can protect your stock with options. So if it starts to come down, okay, yeah, I'm losing a little money on my shares of stock, but I'm making it on the opposite side on the option. So I'm
Yeah.
not losing anything. So when silver ran up like that, I had somebody I was working with and I said, "Hey, he's, bragging about how good how much money he's making on his silver." And then I told him this on Sunday, and by Tuesday, Wednesday, silver took a complete reverse, like it was over $100 per ounce, and or yeah, whatever the price was, and it reversed back down to 60 something.
Yeah. Yeah.
Yeah, just like that. Like literally after I told him, and then I showed him an example because he kind of shot me down. He said, "Well, that just means I'm going to buy more." And I said, "Well, you could have protected yourself, and when it went down, and you still could have bought more at the lower price." So those are the different strategies and things that, depending on what you're trying to accomplish, I'll work with you and say, "Hey, if you come to me and say, 'Hey, Sharae, this is what I'm trying to do,' then I'm going to help you. This is what you need to do in order to accomplish that." But everybody's different, so I got to take it on a case by case basis.
Yeah.
So bull market. So think of a bull. When a bull charges, a bull has horns. When a bull charges, it charges in an upward motion. So that's where that came from. Simple. So when you hear, you're watching the news or reading the news and you hear them saying, "Oh," and they're talking about the bulls and the bears. Bulls mean those are investors that believe that the market is doing well, and they compete with each other throughout the day. You will hear, if you're listening to CNN or some kind of financial news, they're talking about bulls and bears and who's winning and who's taking over, and I mean it's described like a whole battle throughout the day. So in a bull market, that means the stock prices are rising. They're going up. The economy's doing well. Everybody's feeling good. They're spending money. All is well. And there's a belief that this upward trend will continue. So think about it like this. If you're investing in the market is going up. You're going to want to put more money in because you want to keep growing your money. It's going good. Let me keep getting some more of this, right? Versus, mm, oh, I'm not on presentation mode. That's why. There we go. Um, that's not on my screen. Okay. Versus a bear market. So when a bear attacks in a downward motion, right? And that's what that signifies. When they're describing a bear market, they're talking about a period where prices are going down. So like right now, I'm not going to say we're in a bear market, but prices are starting to retreat, even though they were just at all-time highs. So that's why I'm not saying yet that we're in a bear market, because we're still pretty high on our prices. So a period of falling stock prices, investors are feeling negative. That's not what's happening right now. And that's why I'm cautious to say we're in a bear market, because when these prices drop, people see these as opportunities to get in on sale because we were just at all-time highs. So that's why I was saying it doesn't necessarily mean, hey, this thing is getting ready to bottom out. Um, but that's what a bear market means. Investors are, oh my, this darn mouse. Investors are feeling negative about the market. So we are starting to see a retreat back, though. We really are. Pessimistic about economic conditions, layoffs, different. I think they just produced the reports for January. There has been an increase in layoffs. The belief that things will get worse before they get better. So that's going to determine. That's really the main thing that's going to determine. If investors believe that, hey, this thing is not going to turn around, we're getting ready to just start going down, they're going to start pulling out of the market. And that's where you're going to start to see prices start to decline down to levels that we would have concerns about, recessions, different things like that. But right now, we are not there. And then this is just a quick recap. So the top chart is more so just a comparison between the two. But what I wanted to emphasize here is investor action. So based on whether or not, remember I said bulls and bears, this is about investor belief, what investors believe. And they compete against each other all day long, or that's how the market moves, bulls and bears competing against each other. And actually, I'll show you in Robinhood, they actually have a table that says this is how the bulls view this stock, and this is how the bears view this stock. So in a bull market, people are going to invest more aggressively. So it's about your view of the market. So on days when the stock is down, you're going to view that as a buying opportunity. If you're a person with the mindset that, hey, economy's doing well, it's going to continue to do well, then you're going to be investing. Versus a bear, they're more concerned about protecting their capital. So if your mindset is, hey, I think we're getting ready, the economy's getting ready to go down, oh no, that fear type thing, those are the people that are going to start selling and pulling out and putting their money instead into more stable investments like your treasury, your bonds, different things like that. They're going to be even just sitting in cash and waiting for an opportunity and doing nothing at all. So recognizing market trends allows for better timing, strategy, and risk management. So that's why you want to pay attention to what type of market we're in, a bull market versus a bear market. Because as we talked about, stocks you can easily adjust, sell, buy, whatever you need to do based on market conditions. Okay.
Sharae, can I ask you a question? So in a bull market, in a bull market, once we start getting indication, just say like the scenario you just mentioned, those that's in the mindset that the economy is doing well, that they would then they would put more capital into the economy. So at the indication of the economy starting to slip into a bear market, this is when we would sell, correct? And then we would get back in once that particular those stocks can either bottom out or they hit to a point where we know it's going to go back up. It's just when we're going to buy, and then it's when we sell.
Well, so that'll be part of your decision.
Okay.
Like, so the risk, that's where the risk management, right? So when you put money into the market, there's two things that could happen. There's only two things that could happen. Either that money is going to make money or it's going to lose money. You decide what your risk tolerance is. Is one of the slides coming in, and I ask each of you to determine what your risk tolerance is. So it sounds like to me, based off of, you made this comment twice now. So if I had to label your risk profile, I would consider you to be a moderate, meaning that you are concerned about capital preservation, meaning when the stock market starts to slide, you're going to be a person that wants to make a decision and say, hey, no, I want to get out and protect what I have.
Correct.
And then I want to go back in aggressive and build it back up.
Correct.
So that's a
Correct.
moderate. That's a person that's a combination of the two. So I have
Yeah, I'm a
people that are,
combination. Yeah, for sure.
yeah, I have some people that are conservative. They're concerned about capital preservation only. So, hey, they
Yeah.
have very low. So, yes, to answer that question.
Yeah. Yeah. I'm a little bit of a risk taker. So, but as I'm getting older, I'm just getting more, protective of just sustaining what we make. So,
Right. Yeah. So that'd be moderate. That's part risk. You have an appetite for risk, but at the same time, you have capital preservation as well. I have
correct.
people that are completely aggressive. Usually, my male clients they tend to be more aggressive. My female clients tend to be more conservative. I don't want to lose any money. I don't want to lose any money. They're very concerned. Males are like, it's the casino. I'll just put another $1,000 in there. Okay,
Exactly.
that's what you want to do. So. Women, not so much. All right. So, with that said, we are going to move into, and at the top of the hour, we're going to take a 15-minute break. I forgot that part too. Okay. So institutional versus retail investors, and what are the differences between the two? Me and this mouse. This thing is super sensitive. All right. So, retail investors, the difference between retail investors and institutional. So, institutional traders are your large hedge funds, those are entities, your banks, the ones that manage pension funds, government, retirement plans, employer group 401k plans. They work with high net worth individuals. Those are your institutional traders. We call that big money. Then you have your retail traders. So those are individuals just participating in the market. Thank goodness to the invention of these trading and brokerage apps. So now it puts investing into the hands of everyday people. So we are going to discuss the difference. So, how are they different? Volume and impact. So, retail traders, we're large in numbers, but our order sizes, meaning when we're going to purchase shares of stock, you might have an institutional trader saying, hey, give me 10,000 shares of Apple, versus a retail trader that might just only be putting in an order for 10 shares of Apple. Because of that, they are not able to influence, retail traders are not able to influence the market as much as institutional traders because of the volume size of the orders. So when I'm looking at the market, sometimes I can tell when there is market manipulation, because if I'm a institutional trader and I'm sitting on one side of the market, meaning maybe I have options positions and I need this price to come down, what I'm going to do is put in a lot, what I see is a large order being placed at a price that's well below the market price, what the current market rate is, trying to drive the price down. You can also see the opposite side of that, where they'll put in a price that's more than. So what used to happen is you used to have institutional traders competing against each other. So that kind of helped keep price in check. But now you have retail traders also participating. So that's why the stock market, when we look at some charts, you will see, if you go back before 2020, the stock market just gradually went up unless there was something major happening that caused it to go down. Now the market is very volatile, up, down, up, down, up, down. And it's because now you have retail traders who are large in numbers participating in the stock market. So that's what's causing so much market volatility in the last 5 to 6 years compared to what it has been historically, when the major players were just institutional traders competing against each other. I mentioned that big transactions impact stock price. And then because of those volumes, as I mentioned before, they have the ability to move the entire sector. We just, our volume just way too low. We can't do that. Okay. Influence through the media and market sentiment. So institutional traders, they rely on analyst reports, news outlets, different things like that. They're able to shape public sentiment. So what happens is analysts will produce like a rating, and we're going to go over that. Analysts will produce a rating on a company. That rating is going to cause the stock price to either go up or down, and that information gets published, and then on the back end we don't see it until after the fact, meaning retail traders don't see it until after the fact. We more react to what's happening. We react to what's happening in the media versus they're the ones that actually shape it. They're the ones that form what's happening in the media. Oh, this thing. Um, and then for institutional traders, they're backed by credibility, right? They hire individuals with finance degrees, different things like that. So whatever they publish is more credible compared to, we talked about social media and meme stocks. What happens on social media, what happens with social media is that someone has a large social media following, they'll say, hey, go buy this stock, everybody go runs, rushes to that stock. What tends to happen is that the ones that bought at the bottom, at some point it's going to run out and then reverse back around. So that's how institutional traders and retail traders influence the market through the media. Information advantage. So institutional traders have access to exclusive information. That's why Martha Stewart went to jail. I don't know. I'm not having dinner or getting invited to the wedding of a Fortune 500, company CEO. So basically, that is what this is. Institutional traders have access to exclusive information. They usually participate on the board of companies. They are in meetings with politicians. They're funding these political campaigns, so they get access to information that you and I don't have access to as part of the general public. Um, Institutional traders, as I mentioned before, they have dedicated research teams. So what they're able to do is say, hey, this group of people, you only research pharmaceutical stocks. You only research the automotive industry. You only research, hospitality industry or gaming industry. And then they're able to go do a deep dive, come back, provide recommendations. Whereas us, we are individuals, we are relying on, like I just showed you, those websites like thebarchart.com, what's published in the news, that type of thing. Our depth of analysis is very limited to what information has been published, whereas they have access to like inside information. And then the same thing with the algorithms. They have, teams of people that can create these sophisticated algorithms that can read through data. Again, I have a data analysis background, and it's kind of where my strategies came from. I studied the data for 2 years. Nobody's ever done that. And remember, I just talked about the fact that the market has changed from where it was. So basically, what's happening is old methods for investing and trading are being applied to a new environment. Well, I stopped for 22 years, studied the data, identified new patterns in the market, and that's why my strategies yield greater results than what is being taught by other people. So, and that is it. Are we at the top of the hour? Okay, so we're gonna break here. We're gonna break for 15 minutes. So let's come back at 12:15, and then we'll finish up. We have three areas: trading versus investing. Trading versus investing, and then we do investor profile, and then we do trading psychology. So we have three more main areas. Okay.
Yeah.
All right. Break
All
for
right.
15.
We'll see you in 15 minutes.
Yep.
Thank you.
Okay. So from here, we are going to move on to trading and investing. So, what is the difference between trading and investing? Because whatever your goals are, that'll dictate how you approach the market. No, it's not letting me. What? I gotta figure this thing out. just gonna do it from here because it's easier. Okay. So time horizon and strategy. So as I mentioned before, the difference between trading and investing. So when you are trading, you're more focused on technical analysis, and basically what that means is the charts, how the charts actually move up, down, up, down. Is more sensitive to the market. So when we talked about making sure you're understanding what's going on in the market, meaning you're going to be making frequent buying and selling decisions when you're trading. Versus if you're investing, you're more interested in fundamentals. So what that means is more long term. What is the health of this company long term, right? We know that when companies do business, they might not see returns or from the activities that they're doing today for 5, 10 years down the line. So think about companies like your Amazons. Years ago, Amazon, I think they started out like a book. I know I used to, when I was in college in the 90s, I used to order my textbooks as a way to get books cheaper than going to the local bookstore that was on my campus. That's how they started out, but then they've grown into what they are today. So again, an investment in Amazon way back then, 10, 15, 20 years later, now it's worth, significantly more. So that's the difference, is you're looking at more long term. So investing is more for like retirement, down payment on a home, fund your children's education, that type of thing like that. With investing, it's more compounding, meaning over time, like $1 today turns into $5 in a week, next year, $10 the year after that. Versus trading, that's more of like an income kind of approach, right? Like with me no longer working, still relatively young, so I still trade as a way to replace the income that I lost from no longer drawing in a salary. So that's the way to think about it. So you determine for yourself, like, okay, what is my goal? Am I trying to be a trader? Am I trying to invest? Because whatever you decide, and it could be a combination of the both, it doesn't have to be one or the other, but that will just determine, what you do. So for me, I have multiple accounts. I just have some trading accounts. Ones I just go in and play with, whatever, that's like my spending money type thing. But then I still have to make sure that I'm good long term financially. So those are my investing accounts. So I treat those differently. I'm not checking those every day and making changes to those. Risk, reward, and time. So we talked about that. When you're invested in the market, there's the risk that you could lose money. So trading is more sensitive to risk, to the market. Investing, slower, long term. We know the market's going to go up and down. So trading, there's higher risk because it's a shorter time frame. So you're looking to get in, get out quick. So that requires more attention versus investing, which is more long term. So you don't really need to watch it. Maybe every 3 months, 6 months, a year, you would go in, check your portfolio, see how it's doing, and make decisions at that time. So again, it's up to you. You decide how you want to do it. If you know that you can't watch it, I have clients that are truck drivers and stuff like that, firefighters. They know that they can't sit back and watch the chart. So I would not recommend investments that are like require short time frames. You can do it, but we just have to do it, a little farther out on your time frame. Mindset and discipline. Your mindset is going to differ if you're a trader versus an investor. So when you're trading, it requires strong emotional discipline. If you're all over the place, I even saw a video recently where the person said, I wake up in the morning and I check how I'm feeling. If I have something going on, then that might be a day I don't trade because I'm going to be trading based on emotion versus discipline. So you want to be mindful of your emotions when you're trading, fear or greed. So we all fall victim to that as a trader. Fear, meaning I'm not going to get into the market because something, is getting ready to happen. So you stay out. And then here it is. All indication tells you this thing is getting ready to go up, but you're fearful. So you don't take the trade. Or greed. You're in the trade. You're making money. You're trying to make that extra dollar. And now you're down. You lost the money that you had. Um, so these are the types of things that drive your decision making. And then you want to, in trading, you want to avoid impulsive decisions. So my prime example that just happened to me yesterday, when somebody reached out to me. A market closes at 4 p.m. I took a trade. Market closes at 4. This person reached out to me like right at the end of the day and said, "I booked you first thing in the morning." And when I looked and I saw she booked me at 9, I went ahead and just sold my position because I couldn't manage it. I'm like, when the market opens, I don't know what's going to happen, so I sold it. And then it was a bad decision because I missed out on an opportunity to make 500-600% on that trade. So that's one of the things you have to be mindful of, is just making sure that your approach is disciplined and not impulsive. Investing doesn't matter. You pretty much just hold it, let the thing go, and then you just make those decisions. So it's less taxing. I have some clients and they're like, I can't take that stress. So they're more geared towards investing. They don't want that, up, down, up, down.
Yeah, but now once we start uh getting really acclimated on reading the indicators in the chart, that's what's going to minimize, our risk and help our decision, right?
Correct. So I can, let's just use an example here. We can use, ooh.
And I guess their fear would be them not knowing how to read the market. Had they, am I saying this right? Or
No, their fear is not losing money.
yeah, but if they knew how to, like, if they knew what you were teaching us from an option standpoint, wouldn't that reduce their fear factor?
No.
No? Okay.
And here's why. I'm showing you a chart right here.
Okay.
Imagine trying to trade this. You see how this price moved up, down, up, down, up, down,
Yeah.
up, down.
Yeah.
So
I see
how do
it.
you even, no man, you can enter that trade using everything that I just told you, but that I'm going to teach you.
Right.
And as soon as you take that trade, the thing reverses, but then it goes back up. And so what I tend to see is I'm losing money. Oh my God, fear, let me get out. Or I'm everything is telling you what this chart is, what it's getting ready to do. And then they still, like in this case, this indicator would have said it's going up, but because they're watching the price go down, they won't get into the trade so that they're in it, so that when it does go up, they're in it.
Right.
Or they'll wait until it takes off and then they'll jump in it, and then it turns around on them and now they're losing money. So what I typically see when I'm working with my clients is, as soon as they see I paid this and now I'm in a negative, oh my goodness, that's the fear aspect of it. And then the greed aspect of it is the same. They're making money. Oh my God, I paid this. I'm making money. This thing's going to keep on going. And like in this case, and then they don't get out of it, and then it reverses back down on them. So I don't know that it's driven by they don't understand. What I notice is that my clients are pretty good about timing their entries and when to get into their trades. Is how to manage the trade once they get in. That's when that fear and greed kicks in. About, now I got actual money on the line. Once I put my money in, now I start to get fearful or greed, one of the two.
Got it.
All right. Any other questions? No? Okay. So the next thing we're going to move into is understanding risk profile, investor risk profile. So this is where we're talking about what type of investor you are. Um, so the first type of investor that we're going to review is the conservative investor. So that is a person that has a low risk tolerance. And that's okay. It's okay to have a low risk tolerance. You're just going to trade differently. So a conservative investor, that's a person that is concerned with preserving their capital. Whatever they put in the market, they do not. They like, my risk is I don't want to lose any money. That's their mindset, or I don't want to lose very little. So with that said, that person is going to invest in more stable stocks. So when I'm working with people that are conservative investors, I'm pointing them to stocks like Amazon, Walmart, Microsoft, Oracle, your Googles, um, stocks that don't have wild swings. I would not be putting them into stocks like the S&P 500 because that is not, it's stable over time. If this was somebody who said, "Hey, I want to be an investor versus a trader," but if you're going to trade, S&P 500 SPY up down all day long. Um those are the stocks that I would be working with them on investing. So more stable stocks, not ones that have wild swings through the day, which we'll look at some examples. I'm going to put them in stocks that are dividend paying stocks. So those are the ones that every quarter, based on the number of shares of stock that you own, they'll pay you a dividend, so you have some consistent money coming in. CDs, those are typically, that's not something you can invest in through the brokerage account, but these are the types of investments. If I was working with a client that has a conservative investor profile, this is where I would be pointing them to. When you have a conservative investor profile, then you're also, from a risk management perspective, this is a person that is going to use stop loss, meaning they are saying, "Hey, I'm only willing to risk." I've seen someone who said 1% of their portfolio value. That means they have like little to no risk tolerance. 5%. So you'll decide, "Hey, this is how much that I'm willing to risk." And if I see my positions go down by 5% or 1% or whatever that number is that you decided, then you're going to go ahead and exit. So that's how they manage the risk of losing money. They'll also diversify, meaning you're going to be in multiple sectors. You're not going to be all in on a particular area or a particular stock. You're going to, so that way your gains in one area may be offset by losses in another area. And then, as I mentioned before, you're going to trade low volatility stocks. And I'm going to show you in session three, we'll see some examples of low volatility stocks. But basically, what you want is stocks that don't move much. So, like Disney in a day, Ford, stocks like that, they don't move very much in a day. So, if you just have some money, you want to put it in the market, you want to see what it does, you will put it into something like that. You can't expect that if you bought a share of Ford stock today, you're going to wake up tomorrow or a week from now and you're up $20 on that stock. It just doesn't move that much like that. The
With
next,
buying, you mean with buying and holding stock, but with options, we that could that's not the rule of thumb.
even with options, so if I was working with a person who's an options trader, even with options, you could take the same, let's just say a Ford contract. We can look one up. Um, if you looked at a Ford contract, which I put people in Ford. We'll look at it here. Options. All right, so we'll look at Ford. Actually, oh, I use this for my training. Okay, so it's somewhere here. So the difference between a Ford contract today, this is zero. Nobody wants this contract. But previous close was $8. The highest this contract got today was $14 only. So that's a difference. That's something that doesn't move a lot. Now I'm going to show you an example where $8 turned into something significant. That's a low. Ford would be a low volatility stock. We will go with. Okay, this is $13, and it was as high as 137 today. Now we're $70. You're not going to see something like this on a Ford. You're not going to wake up. It would have to be something really significant. So, like, this was $9 yesterday. It was high as $94 today. It's now worth $36.
But would this be considered a high volatile?
Yes. Yes. Very volatile. So if you're trading something like this is one you're going to have to watch because it's going to be up, down. So just how quickly it was at 94. So the person bought at 94 is now holding something only worth 13. So that's why you can't just buy it and hold it, because it's going to go up, down all day long. And this is significant, right? If I bought something, we looked at the Ford example, it was $8, $9. Let's just say I bought it at 8, it went up to 13, and if it goes to zero, oh well, I only lost what? Out my initial investment was $8, $9. If I bought something at 9 and it went up to 94, and then I didn't sell it and it's now worth 30, my feelings are gonna be hurt.
You see how this is trading right now? It's trading in live time.
Yeah. So when we do our practice, we'll be able to look at that. And then also, because you guys are going to be majority of the time when I do the classes, most people book outside of business hours, outside of the time that the market is open. So the market is open 9:30 to 4. So in session 2, when we're going through the education piece, you will actually have the benefit of seeing it happen in real time. Most of the times I'm doing the education piece outside of business hours too. So yeah, this is what you're able to see. So like the contract that I was speaking of this morning, I bought it at 44. The one I bought yesterday, and then I sold it because the client told somebody booked me. Had I just held it, the lowest it was today was 140. So think about it, about like, say if you were buying a share of stock. If I came to you, if I said, hey, go buy this, and it was $44, it's now worth $230. You won't get that if you're buying actual shares of stock. So that's why you want to do the options. And I'm going to teach you the process for how to be the person. I paid $48. We can go to my thing. The low was 44. I paid 48. I teach you how to be the person buying at or near the low and then selling at a price greater. Again, I just sold this because somebody booked me, but it expires today's date. I sold it yesterday. I'm going to go here after the market closed because somebody came to me and said they booked me, but so that was my fault. Impulsive decision making, it's on there. But had I held it right now, I would be holding a contract that is now worth here, I'll put it on my watch list. And this is when I say we're going to be practicing, that's what we're going to be doing. We're going to be using the watch list. Let me see here, 263 put. Had I held it, so when I put it on my watch list, it was $47. If I still own this, this is what it would be worth. I would be up 400%. It would be worth 225. Or if I sold it at when it was at 300.
That's crazy.
Yeah, yeah.
And
And so
when you mean contract, one contract is 100 shares,
one
right?
one contract is equivalent to 100 shares, correct?
Oh my goodness.
Yeah.
Oof.
So when you see 47, you would just take 47 this 47 cents times 100. So to buy this contract, it cost me $47. And then this contract is now worth 227. So you can buy multiple. So say for instance I had bought 10 of these at $47 a piece. That'd be 470. My 470 investment would now be over $2,000.
Yeah, you see that?
One
Yeah,
day from one day to
great.
the next. So you could buy 100 of these contracts. So now your 4,000 investment is now worth $20,000.
I hope that client was worth it.
No, actually it was a free, like I do an info free session.
Oh, it was free. Oh my
But
goodness.
before I like the onboarding,
Oh
yeah.
my goodness.
Yeah,
Yeah.
yeah.
So
We
Ooh-wee.
could have.
I mean, in full transparency, once I made this a business and started coaching, I'm not as successful as I was when I was just over here doing it on my own.
Ooh.
I noticed like some of the mindsets, different things that I've experienced with clients. I feel like I'm taking some of that like stuff on. I don't know. But I
You
mean, I'm going to teach. That's my goal. Teach y'all the process, and I'm going
right.
to teach you the right way to do it because I had to teach myself the right way to do it. And then when people saw my results, that's what happened on social media. I started sharing in those groups, and I didn't know that I was doing it so fundamentally different than everybody else. And they like, what? How? And they were trying to look at their charts and see. And then I realized I was on to something. And then they came to me like crazy. Like I was not planning to do a business at all. It just happened. Because people started asking me, can you coach? Can you help? And I mean, I was just busy all day. And so then I wasn't making the money that I was typically making when I was doing it just over here in my little shell.
I got a question. I got a question. So what?
with this, do you have, because I know there's some groups where they do like FaceTime. I see it on YouTube. They do like FaceTime and they trade in the morning. Do you have groups like that? Do you have a group like that
I
that you?
I don't. So I do
Oh,
have a private group, but I don't do live trading. So those groups charge a monthly, I think they charge like a monthly fee or something like that for
correct.
you to watch them trade. The problem with that is I can make way more money than I can make by them groups
Right,
doing it on
right.
my own, just over here in my bucket doing it on my own. So I do not charge, I do not run a monthly, I don't do what you see other people do, I do not do.
Hmm. Okay.
Is the answer to that question. And it's just because I literally, and I probably have examples on my page, it literally could take me, I could probably do $2 or $3,000 in 30 minutes. There's no, now I'm in this group, I'm trying to answer questions, I'm doing this, I'm doing that. And that's what I notice. I miss a lot of things because you're teaching, right? When you're and it's live, the market's open versus me just doing what I'm doing. I'm doing more explaining than I'm doing executing, if that makes sense.
Right, right. Got you.
So I just prefer if I had help maybe, but yeah, I don't. So, but I'm gonna teach you this, so you gonna be a okay. All you have to do is execute what you learn.
That's right.
Um, okay, so moderate investors, those are people, that's what we talked about. It's kind of what I'm starting to get or hear. And that is a balance between capital growth and preservation. So you got some money, you want to grow it. So you're going to like what I would balance, like, so like the example that I just showed you, when I'm working with somebody that's moderate, I'm a moderate investor. So I might pair an IWM with an Apple. I did I'm gonna go back over here. I paired my IWM with XLF. So this trades based off of the financial sector. So banks, JP Morgan, Visa, Master, Bank of America. So this is what I did with this one. So uh show more. Bought at 17. No, bought at 17, sold at 17. I had some because I use this for training. Okay. So bought at 19. So I bought this yesterday. I actually bought it after the market closed. Bought it at $19 and turned around and sold it this morning for 48. And again, I was telling Mo that my target audience is small account investors. So what I do is I run a $20 segment. I try to show people how they, even if they just have $20, how they can flip it in the market. This contract now is, I have some larger trades that I do as well, but this is my training account. And I don't want people thinking they need to have like this, a lot of money in order to do this. This contract now that I sold this morning is now worth 68. So that's me taking $20. You don't even have to watch it and turn around. I sold it at what did I say, 48, but it's now worth 60 something. It's been as high as 69. So yesterday was 27. The close was 27. I bought it at 19. Sold it this morning for 48. Had I still held it, I knew I couldn't hold it because we were having these meetings. I had 3 back-to-back meetings this morning, but I would be managing this and watching it. So this is what I'm going to teach you. So think if you bought 10 of them, 27. Well, I bought at 19 a piece. So let's just say you had bought 10 at the 19 a piece. That would have been 190, and your now 190 investment would be worth $660. If you bought 100 of them, 2,700 is now worth 6,600
And that's just in a day.
in a day since yesterday. Yeah. with with my methods. Nobody else, and I can stand on business. Is that a word they say? I
Yeah.
can stand on business. Nobody can get you these kinds of returns. Only my methods will get you these returns. Because I'm going to show you the difference is the method that I created. We don't trade off of candlesticks, and that's the biggest issue. So when I go back to where clients typically struggle, people this is why I was focused on this chart here, how the price moves up, down, up, down. Instead of following my rules, they start looking at how the price is moving. And that's where fear and greed takes place. Fear, it's going down, and you're telling me to buy the one that goes up, but it's going down, so I'm not going to do anything. Take the dang on trade. Or it's going up, I should be getting out of it, but it keeps going up, so I'm just going to hold it. Greed.
So the motto is see profit, take profit.
See, so
I
it's on that, it's in this deck.
I hear
Section,
that a lot. See
section
profit, take
3.
profit. Right.
Section 3, take the profits you can see, not the ones you can't. But I also teach risk management. I'm the only one that teaches it. I teach a strategy is if you're going to hold it. If you look and you see that you're up 20 to 30% or more and you're going to hold it, then I teach you to hedge it in case your decision to hold turns into a bad decision. Then you're not giving the money back to the market. You're paying it to yourself on the opposite side. Nobody teaches that. Only me. All right. So for moderate investors, um, there's a balance between capital growth and preservation. So again, I'll teach you what I typically do. Like I said, I will mirror one of the faster moving ones with one of the slower ones. So that way I can balance it out. You're going to use a mix of stocks and bonds, depending on what your goals are. You're going to rebalance often. So this is what we talked about. You're going to be watching it when you're just conservative. You'll let it go, or investing, you can just let it go. But when you're moderate and you're concerning about preserving your capital, hey, if I'm up, I want to grow my capital, but I also want to preserve it. So if I see I'm up, I'd rather get out, take my profit, and then get back in. So you're going to be watching it more frequently. And then you're going to combine income strategies with growth strategies. So those income strategies, like I just talked about, those stocks that pay dividends, different things like that, versus taking a little bit of risk, which leads us to the next one, which is the aggressive investor. So that's a person with a high risk tolerance. That means I'm trying to make some money. I'm willing to take some risks. Let's get it going, and that's fine if that's if that is your investor profile. I'll just work with you to teach you how to do it so you can be successful. So those are individuals who are willing to take higher risk in pursuit of higher returns. So now you're going to be trading like your MSTR, the ones that go with Bitcoin. We know Bitcoin has a big swing. So you're going to be trading stocks maybe in that space, in the cryptocurrency space. There's a lot of political, I think the new Fed chair that's going to be coming in May. So actually, now that I'm thinking about it, it might be a good time to start taking a look at that, because that new Fed chair is a crypto guy. And so cryptocurrency right now is taking a beating. Maybe in May, he's going to enact some policy. So I would be looking at some contracts with expiration dates in June, September, December, expecting that there's going to be future growth. So again, that's what you're looking for. You're looking for growth opportunities. I'm looking for things that I can put my money in that I'm expecting relatively quickly is going to increase in value. Growth stocks, but that gives me to that one. And then you're going to adjust to revolving market conditions. So like I just said, when you start to come up with pressure with crypto, just using crypto as an example, then you're going to be like, okay, I need to get out and pivot and move to something else. Well, now what are they talking about? For AI was the big thing headed up until 2025, and then that slowed down. So AI stocks were moving and shaking. Once they're done, that's the growth aspect. We're done. It's no longer growing. Then you go ahead, pivot, move out, and go on into something else. So for the aggressive investor, that's the person that's going to be adjusting to the market frequently. Okay. So that's just a comparison of them: risk tolerance, investment actions, the things that you'll do differently, and then how you'll actually manage the risk. So with aggressive, you're just going to adjust to the market conditions. All right, and then this brings us to the last one. This is the one that's really going to impact your success. I can teach you all the things, and I'm going to teach you all of the things the right way to do this. But if you don't have your trading psychology thing in place, this is what's going to impact your success. How much your profits, different things like that. I'm going to teach you the right way. All right. And it's fine. Whatever issues, I'm going to reveal which ones I suffer from, or ones that I struggle with in this process. So it's just you being honest with yourself and identifying for yourself what things you struggle with, and then we just work on a plan to overcome them. All right. So, trading psychology habit number one is sticking to the plan. Sticking to the plan. So, in my case, my plan is every trade that I get, maybe this says, say, I know I can get 100% return. So, I just set a order, a limit order that automatically specify entry and exit rules. If I pay $20 for a contract, I put in a limit order that sells whenever it gets to 40. So that allows me to stick to the plan. I don't get emotional and, oh my goodness, it's up, or oh my goodness, it's going down. Let me go ahead and sell, that kind of thing. So don't rely on your feelings. You're going to follow whatever your plan is. And then that helps you to avoid the impulsive decision making, which is what I said I did. I took that trade. I knew that trade was going to be good, but I sold anyways, just based on the fact that it was just an impulse. Accept that losses are part of the process. You are not going to win every trade. And that's where that whole fear greed thing. I notice I have clients and they just start freaking out. Oh my God, oh my God. They're afraid they're going to lose their money. I've had people tell me they're afraid. So that's how I know. They get very skittish once they hit execute and they're in that trade. They just start like freaking out, like, oh my gosh, I don't. And we're trading small dollars and they're still freaking out. So losses are part of the process. You are not going to win 100% of your trades, but you should. If I'll give you a template, a trading log. So you're going to log. I bought at this price. I sold at this price. This is how much I made. Overall, you should be making more than you're losing. If not, you come back to me. Let's talk about it. Let's figure out what's going on. Let's look at your entries and your exits, and let's put some strategies in place to help you maximize your profits. So losing trades does not define skill. I always say my losses are my lessons. A lot of times when I lose, it's because I didn't follow the plan. Just doing my own thing. Losses are the cost of doing business, and we want to focus on consistency and discipline rather than individual wins and losses. So that's where I was saying through that practice process, we're going to be going through some repetitions, 4 hours worth of repetition, not 4 hours, 12 hours worth of repetition, just to make sure that you understand the whole process flow through and being able to react and make decisions, because no 2 days are going to look alike. So you just want to focus on being consistent, being disciplined, and not being emotional. Which leads me to the next one. Habit 3. So emotion, control your emotions. So we talked about this one already extensively. So fear, greed. So fear creates hesitation. What I typically see is one of two things. They don't take the trade because they just fearful that they're going to lose their money. And greed causes over trading or holding too long. So that's where you're going to use your journaling. You're just going to be intact with your emotions. And then there's a fear and greed index, which I actually pulled it up. So at this time, when I took the screenshot, we were in the fear stage. But CNN actually has an index where they track fear and greed. And that's where we're at. We're headed back towards fear. That's where we are. A month ago, we were in greed. A week ago, now we're moving back towards fear. So that's giving you an idea what emotion is driving the market right now. People are starting to get fearful. We just came out of here. We're not all the way, back here. But that's just something to be mindful of. If that's like, what is your view of the market? Because that's going to dictate what you do. Patience and consistency. So what I typically see there is people, I'm going to teach you the strategies. And what it is they'll go before. And it's like, well, no, you should have waited. You went too soon. Those types of things. So some days the market moves fast. Some days the market moves slow. Some days I feel like I'm sitting here watching paint dry. Yesterday I went to go get coffee. It was doing its thing. I went to go get coffee. I came back. I missed my opportunity to get in. So that is one of the things. If you're impatient, that's fine. You can be impatient. I'm going to just teach you a strategy to overcome that. What you're going to do if you're not patient and you know that you can't wait and you can't just sit here and watch the charts or whatever. It's just not for me. I'm going to teach you a strategy for still being able to take your trade, use it a limit order in order to get in. So that way you don't have to watch it. Let the system automatically fill it for you if your price is met, that type of thing. Stick with one strategy long enough to learn and improve. So what also happens is when people, especially my beginners, I can always tell when they've started going on YouTube University because then they'll come back to me and they're using terminologies and things, and I'm like, you didn't hear that from me. You didn't learn that from me. So what I suggest is that what I'm going to teach you, I'm not saying one or the other, but what I'm saying is if you decide somebody else's method works better for you, then use their method, or study and learn and use my method. I'm going to teach you my way. Just stick with it long enough till you can get it, and then repetition builds efficiency. So we always give nobody, if you think any profession that you have, you're not as proficient on day one as you are in year 15. That's just the way it is. Manage your risk on every trade. I have people who do not want to manage their risk, and that's fine. If you don't want to, you don't have to. But this is what I teach. So think of your risk first. So when people approach the stock market, they approach the stock market with the mindset of how much money am I going to make? And I'm going to challenge you to change that mindset to say, how much money could I lose? So when you think about how much money could you lose, then reality is you want to protect that, right? So that's where you want to manage your risk. Think about it that the make money is going to come as long as you manage the risk of losing money first. So what you're going to do, you want to set your stop losses. You want to know going into this trade, how much am I willing to risk on this trade? Now, I have people that say, no, I'm going to be honest. Sometimes I don't. I'll just put my trade in and that thing will be down 60%, 40% before it turns around because I have a strong conviction. I'm not saying it's the best way to do it, but that's part of my trading psychology. And then you want to protect your capital above all else. So main thing is you want to be able to survive to trade another day. Okay? Don't want to go broke. The other trading psychology is FOMO, what's called FOMO, fear of missing out. So you want to avoid following the actions of a larger group. So that's what I typically see when you start following like social media groups and everybody's in the group and they're talking about this and everybody goes run to that one. Well, eventually it's going to run out. And what would happen with that IBXR, I'll pull it up real quick. This is one of the meme stocks that just came, and I'm sure IBRX, here it is. All right, so here it is. Okay, back. All right, so back here, February 13th, this was a $6 stock. It became a meme stock. All of a sudden it took off. And it got up to, let's see here, what, $12. So it doubled before it pulled back. So basically what was happening, this is how you can know it's a meme stock, because then the people that bought here, now they're selling, they made their money, they're getting out. But then you got new people, and then it goes here, and then they sell, and they're getting out. This isn't normal behavior when you see stocks doing that, and they're all over social media. That's what drove this increase like that. So that's one of the things that you typically see is fear of missing out. When it gets on social media, somebody starts talking about it. That's what happened with GameStop and AMC during the pandemic. It was just like it wasn't real. It was like that stock, there was nothing that company was doing that would cause that stock to go up like that. So you only want to take trades that meet your setup criteria. And then I always say a missed trade is better than a forced one. If it's a trade that I didn't take, that's fine. I didn't lose any money. I just wait for the next opportunity versus trying to follow or chase a trade and risking the risk of losing money. So when the person came to me on Saturday, he's in Colorado or something, he was trying to explain to me to take that. And I said, no, I wouldn't do that. And for sure it turned around and came back down. So I hope he followed my instructions. Confirmation bias. So when we talked about, I said, I'm going to reveal mine. This is one of mine. This is something that I struggle with. So confirmation bias is the belief, or you seek information that supports your existing belief about a trade. So what typically happens is I'll be like reading something and then I'll be like, oh yeah, the stock's going to go up or it's going to go down. And I take a trade based on that, based on what I think is going to happen, and then I look for information that's going to support it, and I'm always wrong. So I need to stop doing it. Always wrong. Tendency to follow analysts or news sources that agrees with that belief. So I could be on YouTube and some traders on there talking about this is going to happen, and that's not what and that's absolutely not what happens. And this is something that I notice for myself. I'm easily influenced by the opinions of other people, even though if it goes against my strategy. So that's something that I have to overcome. So in order to do that, you're going to use your checklist. You're going to just stay on track with what I teach you. So that way you're not following opinions of other people. And that is it, actually. That is the end. The end. I'm going to kind of end it. Let's see here. Stop sharing. Stop sharing. Okay. So that is the end for session 1. So I'm going to open it up. You have any questions for me?
Not at the moment, not me.
Okay. So understand.
I'm all good.
Y'all following along at this point?
Yeah.
Easy to understand?
Yeah.
That's
Right.
I'm ready.
The next one, that's when we're going to get into the charts and the strategies and all of that kind of stuff. So that's where you're going to bring your thinking caps. We're going to use your thinking caps. Okay, so the next session, that's what we're going to do. We're going to set up our brokerage accounts. We are going to review charts and strategies. I'm going to teach you my strategies, the 3 strategies that I developed, and then we're going to go through the trade entry process. I have a 4-step trade entry process that I teach. So that's what we're going to do in the next class. Okay. And then there's going to be homework. So check your email because I'm going to give you instructions. One, I want you to set your account up on Robinhood if you want to follow along during the class. So you don't have to fund it, just set it up so that way you can follow along. And then I want you to apply for options trading. So there's actually a process that you have to, application that you have to complete for options trading. And when you complete that application, it's going to ask, it's going to ask questions about your risk tolerance. You want to indicate that you have a higher risk tolerance. Don't answer like you're new and you're concerned about losing money because they won't approve you. So when you're going through those questions about risk tolerance, always select like the highest one or the next to highest one in terms of risk. But
this is when we're setting up Robinhood, right?
Yeah, so
Okay.
you're going to set up your Robinhood, but then there's going to be 2 things I want you to do. I want you to apply for options trading, and there's an application process for options. And they're going to ask you questions about your risk tolerance.
Mm-hmm.
When they ask you those questions, I want you to answer them as if you're an experienced investor. So they might say, oh, do you, what was one of the questions? Do you care about, they'll ask like, do you care about capital preservation, growth, or
say no.
Yeah, you're going to select, your growth. You're interested in growth. You're willing to take on higher risk. So you're just going to answer it as if you're an experienced trader. They're going to ask how long have you been doing it. Don't put 0 to 1. Put, if it's 3 to 5 or greater than 5, select the higher, the ones that indicate that you have a higher risk profile. But I'm going to send you the I'm going to put it all in the email.
Yep.
I've had somebody who went ahead of me and then they couldn't get approved and all of that. So don't go ahead of me. Let me kind of coach you. And then if you have questions when you're doing the actual application, I'll put my phone number in there. You can text me. I'm available pretty much all day. When you're doing the application, if you have a question about how to answer a question, just text it to me and I'll tell you what the answer. And then the other thing is setting up a cash account versus a margin account, which we'll go over, but it'll all be in the text message. But you don't have to actually fund the account. I just want you to have it set up so that way when we're setting up the charts and doing different things, you can follow along. Okay.
There was in your email, you stated there was some documents, I guess some material.
Mm-hmm.
I can't open it up for some reason.
You can't open up the first email that I sent. Are you saying you're going to the link and it won't allow you to open it?
Correct. It's not giving me anything. I'm clicking on the link.
you're clicking on the link, and it should be opening in Google Drive,
Let me see. Well,
and it'll be a folder. So I'll resend it after this. I'm gonna download your recording. I'm gonna put all of it is posted in the same place, and I'm gonna resend that link, and then let me know if you can't open it. You should be. I don't know. I do it the
oh
same
wait,
way.
is it the I don't know, maybe let me see, maybe this is what I'm is this the marketing material? Is this the material here?
Mm-hmm. Yep.
This is
That,
it?
so this is the slides for this presentation, the ones I
Okay,
just went through. So after this session, I'm going to send you SE2 for session number 2.
okay, okay.
Yeah.
All
And
right,
then they're also saved on Google Drive as well within your folder for your
got
group.
it. Yeah.
And then the recordings will be there as well. So yeah, but after each session, I'll send you a link to the recordings. I'm gonna attach the next week's deck, so that way you can go over it in advance if you want. You can come prepared with
Yes.
questions and stuff like that.
All right, good. This was great. It
Oh,
was great
glad.
training. Thank you so much.
Oh, you're welcome. You're welcome. I'm excited. I'm glad to have you all.
Uh,
Yes.
I have a question.
Thank you.
Sure. Hi, Noah. Sorry.
I'm sure. Should I download Robinhood on my iPad or my phone?
So it doesn't matter if you do it on the iPad or the phone, it's going to give you the app version. But when I'm training you, so the app version is a little different than the desktop versions. But when you create your account, most people trade from their phones. I do as well. So it looks a little different. But if you do it on your iPad, then you can just go in your browser and type www.robinhood.com. When you do it that way, you'll get the same view like you're viewing it on a desktop.
Okay.
Yeah. So it's really the option. The choice is up to you. I probably would do it on the device that you're going to be using more frequently, and we'll just because I typically especially when I'm in my group classes, like it's more than one of you on here. So what I end up doing is I'll end up linking my cell phone and then showing them how to set it up on the app version as well as the desktop. But I'm going to teach from the desktop version.
Okay, cool.
Okay.
Okay.
I got a crazy question for you. Can people use say if they got a line of credit cards, can they trade from that?
I don't believe so. So you're talking about to fund the
Yeah.
actual account. I don't believe so because I think I had a client that tried that some years ago.
Yeah,
So
that don't work.
yeah, it's like link. I think it wants to link to like a bank account or something.
Okay.
Yeah, yeah. I
Okay.
don't think it allows the link to like a credit card. No, I don't think. Well, it may now, but I know 23. I think I had a client 23, 24, 23 time frame that tried that.
Should we be buying crypto now too at the same time as we're going through option trade? So whoever we're doing, whatever options we're buying, should we own that same company in crypto?
Well, crypto is digital currency. That's different.
Right, I know. So we own that too. I mean,
Oh, you can. Yeah, if you want
you know what
if
I
you
mean?
want
Just
to
kind of like
invest in yeah. Yeah, so that's part of your diversification, right? If you
right.
want to, your portfolio to include, options and shares of actual stock and crypto, what I'm going to teach to you, it works. The strategies will work on if you're looking at a chart for crypto versus looking at a chart for
Okay.
McDonald's.
It's across the board.
Yes, yeah.
Okay.
You're going to see those same patterns in the charts no matter what. So when people were running a Bitcoin and I was saying stay out, like right now the last time I bought Bitcoin it was 59,000 and then I sold, so that was September of 23 maybe or 24. One of those, it was September. I know it was a September. But anyways, so it ran up and then I got out of it. So what happened is once it got to 100, everybody started running to it. No, it's been as low as 63 this past week. If you look
Right.
at
Yeah.
the chart for crypto for Bitcoin.
It's like
So I'm
62.
sitting back waiting. Is it 62 now?
It was at 62. It dropped
Yeah,
down.
yeah. So I have a alert set up on it. If it goes back below 60, then I'm going to get back in. That's ideally what you want to do. You want to buy the dips. What tends to happen is once it starts taking off, what they said is, "Oh no, it's going to 1 million. You better get in." And I was sitting back watching people buy when it was over 100,000 and saying to myself, "There's a better time to buy.
Right.
You don't go at the highs." So yeah, if you wanted to start now, we could, again, I haven't looked at the chart because I set my target because I know I got it at 59 a couple years ago, so I'm waiting for it to go back below 60. That's a cheap enough price that I'm willing to get back in.
Mhm.
But you can start now. I mean, it may not get to 59, so that'd be a risk I'm willing. Remember, no trade. I can't lose any money if I don't get in, but I also wouldn't make it either if I stay out. So it's a risk I'm willing to take. Any
Yeah,
other
I think
questions?
Uh,
I'm good.
do you want to take my Gmail for the homework?
Um, I think I might have. Yeah, you can send it to me. Yeah, I just do one email and I put it on
Yeah,
there.
he's not on that thread.
Okay, you can give it to me.
Okay, it's Canon Noah 553 at gmail.com.
553.
Is
Okay.
Tanai on that thread?
I'm
Yes,
not sure.
I'm here.
What'd you
The
say?
email.
Yes or no?
Tanai, are you on that email thread? I think she needs to be added.
Sorry, I'm getting my hair done. I can put it in the chat.
Okay. Or you could just send me an email to S Investment Group at in the two spelled out TWO, like my initial, investment group at gmail.com.
No,
Send me
send
an
an
email.
email. Send her email address as well for her.
All
There you
right.
go. Well, she put it inside the chat.
Yep, I see it. Yeah. Okay. Anything else?
Nope.
All right.
Thank you. We'll see you on next Friday.
Next Friday. All right.
Thank you so much.
You're welcome. You're welcome.
Thank
I'm
you.
excited. I can't wait till
Thank
we get
you.
to the
Thank you so
practice
much.
and making money.
Yes, I'm excited.
All right. Y'all have a good rest of the
You
day.
too.
Are you gonna
Thank
send us
you.
the
Bye.
recording?
I am. I do it after the class. Yeah. So
Okay, cool.
I have to wait for not Amazon, Zoom to download it,
Right.
and then
Download
I
it.
get it posted. Yeah.
Okay. Okay,
Okay.
cool.
All right.
Thanks
Thank you.
again. Awesome training.
Great
Oh,
Awesome.
training.
thank you.
You're
Thank
great.
you. All
Okay.
righty. Bye-bye.
Bye. Bye, everybody.
See you.
Bye.